It's near. Fuck people. One thing you have to learn early in life. I didn't learn this till later on. I don't give a motherfucker. You can't care what anybody thinks about you. If I care what people thought about me, you think I'll be yelling out here, doing 105-pound run, talking shit? This is who I am. Find out who you are, whoever that may be. I don't give a fuck what you are. Find out who you are and own that motherfucker and tell people to go fuck themselves. Don't ever worry about anybody and what the fuck they think about you. You do that, I guarantee you, your life will be in shambles. You will become the biggest bitch of all time.
All right, guys, welcome to another Sunday Fun Day, American Dream in Real Estate. This is my YouTube channel. I'm your boy, Dudley. Do right. And I come to you every Sunday and let you guys know what's going on with me and within real estate accounting. I love real estate accounting, and also I love helping small business owners as well. But today, like you guys heard, we started off our Sunday Fun Day with a little bit different. We usually start with music, but David Goggins is my guy. To him every morning, it gets me up and going. Today is November 1st. 2020. So what are you doing to advance your career and your future right now? Like, it's enough talking. And a lot of people had New Year's resolutions and I'm gonna do everything in 2020, and then the pandemic hit and knocked people upside the head. So what are you doing right now? We got 2 months left of the year to advance your future and not to give a fuck what people think about you. Just go for it. So I'm here to inspire you guys to do better and do more. Being too cautious is the greatest risk of all. Make your dreams reality today. Time is the #1 currency, right? It keeps clicking away. Keep clicking away. I'm 30 now. Say it all the time, but it's here. So use your time now. Use it now to advance yourself and to do what you want. Be yourself. Go on camera and express yourself and your ideas and your business and be able to fuck up and be okay with it, right? We all are not perfect, and I'm not perfect either. And this is a famous quote that I heard from Denzel Washington that I like to say. So he says, without commitment, you will never start. More importantly, without consistency, you will never finish. So I challenge you guys to do more. So in today's Sunday Fun Day, American Dream in Real Estate, we're going to focus on the last 2 months of 2020, guys. You guys know that I love Andy. You guys know that I love real estate accounting and I love just, small business organizations. And today we're just going to talk about some key pain point for real estate investors. If you guys are watching this as a real estate investor and you guys are coming up on, tax season, tax season is coming up on us, but, December 31st kind of gives your cutoff to do anything, right? So you guys want to definitely seek out your CPA, seek out an accountant, reach us at dudleyaccountingservices.com if you guys want to get some tax planning done for your entities. I have one client who has 7 different properties, and then now he's opening up Airbnb, and he has no idea the tax, implications that are going to happen now that he has the Airbnb. So hopefully I get him on a call before the end of the year. But for those of you guys who need tax planning or you don't know what your figures are, right? Today is kind of an eye-opener. If you're a owner, you have no idea how much money you made throughout the year and what your expenses are. If you have expenses, you don't know what all your receipts are. You don't even know how to track your receipts. Today we're going to talk a little bit about that. So I'm going to go off cuff about what I know off my brain. This is not practice or rehearsed. I'm just letting you guys know what I know. So keeping adequate records throughout the year, it gives you an extreme advantage. A lot of people, when they're starting businesses, they get into business like, oh, I can do it DIY, right? Do it type of mentality. And they don't go out and hire a professional, and they're not able to scale because they're spending more time, learning how to become an accountant, learning how to become a tax person, right? And you don't want to do that in business. So you want to really get somebody who knows what they're talking about and really go out there and trust people to get you to the next level. So talk to your CPA, talk to your accountant like right now so you can plan because we got 2 months left out of 2020. So if you guys are in the hole, you guys want to know it. So keeping adequate records will definitely help you figure out where you're at, right? So how tax planning works when you keep good records is, I'm going to write on my little board. I don't really need the board, but I'm going to write it on anyway. How tax planning works, we're going to use Bob. Bob is our main guy. So Bob has, let's say, Bob has 7 rental properties. Bob has 7 rental properties, right? So he lives in one. He lives in one. So let me break this down a little bit better. So he has a 2-unit building, and he lives in one and rents out one. So he lives in one, rents out one. Then he has another 2-unit. He rents out both units. Then so on and so forth. This is a long example. Let's go down to Bob, a simple example. So I'm not boring you guys with accounting, because accounting gets, so let's say he has 3 rental properties, right? One 2-unit building, one he lives in, one he rents. The second building, he rents both units out. And then the third one, he has 2 units in it, right? And he rents out that one, right? So Bob's circumstance here is kind of like, how can I save on taxes, right? So Bob collects money from all of his tenants and rental income, right? So his income, you guys still can see this, is rental. So his income is rental income. So we use Schedule E to file our taxes for rental income, right? So Schedule E to file our rental income. There's no self-employment tax on the Schedule E. So Bob get out of the schedule, the self-employment income. But this, his last property, he did an Airbnb out of. Can't write. So his last rental property is an Airbnb. E-N-D. So Bob lives in one, rents out the other unit. Bob rents out the other rental property, and the third rental property, he runs an Airbnb out. Now this Airbnb doesn't necessarily, they receive rental income from one of the units, but one of the units, let's say, just make it simple, for this third property that Bob has, he just rents the whole thing out for Airbnb. This Airbnb income comes in as a business. This income goes to Schedule C. So you get all of Bob's rental income that comes through his property, through his 3 properties from rentals, go into the Schedule E bucket. The Airbnb that he does goes into the Schedule C bucket. You know, as we always talk about, Schedule C income is not really that good because you're paying 15.3% in self-employment tax. Then you're paying around, on average, 14% in income tax. Then you pay, say, 5% in state taxes. So, all in all, this guy's paying 35% tax on his income from his Airbnb. Now, Bob, let's say simplicity. Keep saying for simplicity. Simplexity. So Bob has to pay 35% taxes on everything he makes from his Airbnb. His Schedule E income is going to be met with depreciation. Depreciation will knock down his Schedule C income. And usually people who are in real estate, this is why it's a dream to own real estate, because the depreciation knocks down your rental income. Say if you made $10K in rental income, but if you made $10K in rental income, but you depreciated your property, and your entire depreciation knocked down, let's say your depreciation was 20K depreciation. Say it was 20K. Now on paper, you have a $10,000 loss, and this $10,000 loss can be carried forward. Carry forward. This $10,000 loss can be carried forward until the next years, until you have more income to offset it. So you have more rental income, in year 2 and year 3, you have this loss carried forward that you can use to offset that. So basically in real estate, you're not paying any taxes. But Bob got really fancy. He was like, hey, I could make more money, because rental income is I get paid monthly and it's kind of slow. My tenants don't pay on time, and it's a benefit. I get to use depreciation on this. But depreciation is just kicking the can down the road, because eventually when you go to sell the house, in the best case scenario, you sell the house at a gain, you're going to have to pay back tax on this depreciation. It's called depreciation recapture. Depreciation recapture, I think, is like 25%. But the good thing about that, when you sell at a gain, the people who are buying your place are going to pay, in layman's term, they're going to pay that depreciation recapture. So you don't really have to worry about it. As long as you selling at a gain, you don't really have to worry about paying any taxes on that depreciation recapture. Right? But let's go back to Bob got nifty with his third property, and he decided to do Airbnb out of it. So Bob made $100,000. Bob made $100,000 out of his Airbnb for his third rental property, and he's paying 35% tax on that, right? He's paying 35%. So his tax liability, for simplicity, is tax, right? So do you think Bob is going to want to pay $35,000 in taxes? I think not. That's why he reached out to his CPA. He reached out to his accountant. He reaches out to Dudley Accounting Services, because we like doing this. We love planning. So Bob said, hey, Dudley Do-Right, how can you save me money on taxes? It's November 1st, and I don't want to pay $35,000 in taxes. Before you would even know your tax liability is $35K, first of all, you need adequate records, right? I have a lot of people who keep records on their own in an Excel sheet, and they're all over the place, right? Keep adequate records. We use QuickBooks. So use QuickBooks Online, pay $25 a month to keep adequate records, right? And I also did a video on STESSA. You can look, I'll link that above. STESSA is kind of like QuickBooks, but for real estate investors to keep track of their expenses and keep track of their books, so it can be easier through tax time. So if you don't want to pay me, a lot of money to get your book set up, you can do it yourself. I offer that option as well, and I want to train you guys on that as well, because I know, real estate investors are trying to really focus on that cash flow, right? So you don't want to eat up your cash flow, and we understand it. But to understand that we have $35,000 in tax liability, right? And then we have a 10K loss, right? This is our other rental properties. These are these rental properties here. And I'm being really simple. I'm not really accounting for, he lives in one unit in the first property. That would be more of a, accounted for, but just to break it down simple for you guys. When he keeps adequate records, he now sees that he owes $35K in taxes. And it comes to me and he says, "Hey Ellis, how can I like pay less taxes?" Right? So we look at all of this stuff. Basically, we start off by putting all of this stuff in QuickBooks Online so we can actually see his profit and loss statement and his balance sheet. A profit and loss statement is kind of what you make throughout the year, all the activity throughout the year. Your balance sheet is just a snapshot of where you're at when you started your real estate investing company, right? So your balance sheet is kind of a snapshot as you go along. It's never ending until you close the company down. But your profit and loss statement is from January 1st to December 31st. All right. So he comes to us with tax planning. So we address, okay, so out of this Airbnb that you operate, Bob, and we were talking to him, out of this Airbnb that you operate, you live in one of the units in one of your rental properties, and you rent one out. Don't you have a space to where you kind of do office work and you have to kind of write up the lease or kind of do stuff as far as planning on calling a contractor or getting a list of contractors together? Don't you have a space like that in your first property? And he was like, "Yeah, I do. I got a desk set up in this room and everything. It's nice and pretty. I got like 2 monitors or whatever because I'm a geek. I like to geek out and I like to look for some more deals, right?" So we told Bob, you can run a home office out of there, right? You can run a home office. You run a home office out of your first rental, right? And the home office is basically, I'm gonna be super simple. Home office is taking all of your utilities, say utilities, probably spelled this wrong, but oh well, utilities, your cell phone that you use to operate all your rental properties, a cell phone that you use, the desk you bought to put in your home office, the computer that you bought, right? And the great thing about this, and it's more stuff that we can like add to this home office. I just want you guys to get the gist of it. So with utilities, we take the square footage. What's the abbreviation for square footage? We take the square footage of the total of the entire house. We take the square footage of the entire first rental property, let's say 100% the square footage, and then we take the square footage of the actual office space, which, for layman's term, is 25%. It's 25% of the entire house. So we're able to take the square footage of the entire home, right? And then we take the square footage of the actual home office and we divide that by the square footage of the entire home. That gives us a percentage of 25%. Now we get to have fun here, right? We get to take 25% of all of our utilities from like gas, electric, and we get to write it off for our business. We get to write it off under our home office. Now with your cell phone, some people say you can write off your cell phone bill for the whole year for 100%. I say write it off for 80% because you use your cell phone for personal too. You don't use it all for business. So you can take, I would say a safe thing to do is to take 80% 80% of your total cell phone bill throughout the year and deduct that bad boy, right? Then this desk, the desk that you bought, the computer that you bought is 100%. If you guys can see that, it's 100% deductible, right? So we're taking advantage of the home office expense. Now that can lower this $35,000 tax liability down significantly, right? So let's say it lowers it to, I don't want to like keep writing on this to confuse you guys, but say it lowers it to 30K now. Now we're looking at 30K, right? But now we come back. Now we come back and we have to see like, okay, out of this 30K, right? This is 5K deduction. 5K deduction. Now we at 30K tax. And we're at 30K, right? Now we can look at other things, right? So we asked Bob, hey Bob, did you replace any fixtures or anything in the house? Did you replace or put in a new rug? Did you buy a new washer and dryer? And Bob comes back to us and say, no, I haven't bought a new washer and dryer. There's an actual like faucet and stuff in the basement for a washer and dryer, but I ain't got to it yet. So we are November 1st. We're talking about go ahead and buy that washer and dryer, right? The washer and dryer, let's say he buys that November 1st. He takes our advice and he goes and buy that washer and dryer, right? Now the washer and dryer, let's make some room here. Get real nerdy on you guys. That washer and dryer, we have a choice to make now, right? With Bob, we can either capitalize this or we can expense it. So we can either go capitalize and balance sheet. So you capitalize it on the balance sheet or you get to expense it income statement. So this is just a super easy example. Bob decides to buy on November 1st because he reached out to us for tax planning a washer and dryer. This washer and dryer cost him, let's say the washer cost him $2,500 and then the dryer cost him $2,500, right? Now, this is a fixed asset. The washer and dryers are fixed asset, meaning that we can capitalize it, so meaning that we can take the value the cost of a fixed asset, and we can chop it up over the useful life of that asset, right? So say, for a layman's term, I don't have my maker's table on me right now, that the washer and dryer has a 5-year useful life. So you would divide this by 5 and divide the 2,500 by 5, and then in 2020, when you file your taxes, you'll take that one portion. You'll take 1/5 of 2,500 and you'll expense it in 2020. Then 2021, you'll take 2/5 and you'll expense it in 2021, and so on and so forth, right? But $2,500, is that advantageous for us to capitalize that, put it on the balance sheet, keep records, and expense a little bit at a time over the year? No, it's not. So the IRS has given us a can I say this word? I'm gonna try to get it right. De minimis safe harbor rule. That means that anything that you spend in your rental property to fix up, to do a capital improvement, to do a repair, right? You got capital improvements, which is balance sheet, and then repair, which we categorize as an expense, right? But this year, Bob has a $30,000 tax liability. So we want to expense this stuff in 2020. But in order to do this, Bob has 2 months out the year to go and buy this washer and dryer. This is why tax planning is so important. He can't do this on January 1st, 2021. Like, he just can't. He can't go back. He can't do anything. So this is why you get to your accountant. Let's keep going. So in 2020, let me go back to the safe harbor rule. The safe harbor rule says any receipt, like say if you got some windows replaced, but each window costs under $2,500, you can expense each window in the year that you incurred the expense. You don't have to capitalize it and draw it out for the useful life. This is the safe harbor rule that a lot of people are not aware of. So we expense in 2020, $2,500 for the washer because it's under $2,500. Then we expense $2,500 for the dryer, right? We expense this. So that's a $5,000 expense. It's another $5,000 expense. It's another $5,000 expense. Bringing this down to $25,000 of tax liability. But say he buys a washer and dryer for each property that he has, right? Think about this. So you buy a washer and dryer for property number 1, property number 2, property number 3, and you just times this by 3. Times it by 3, 15 grand that you can expense. 15 grand that you can expense, right, in 2020. So he gets his tax plan and we figure out his records, and he's keeping good records. He uses QuickBooks or STESSA. And we figure out, okay, what haven't you bought that you need for your property? The washer and dryer are going to be there for a long time, so you need it. You need it. It's not just like a willy-nilly something you buy. This 15 grand that he bought the washer and dryers for all 3 properties that he has lowers his taxable income. Lowers his taxable income to only $15,000 in taxes. All right, $15,000 in taxable income. Now it goes against his personal income tax rate, whichever one he falls in. But I hope this has been helpful. This is kind of me going off a whim and going off the top of my head of what I know. As I keep going, this is going to be more crisp. I can have a really detailed painting a picture for you guys, if you will. But this guy was paying $35,000 in taxable income. Now we got him down to 15. Now we can do multiple other things. He can get a Roth. He can get a Roth IRA, and I think it's $5,500 that he can contribute to his Roth IRA. And then once he contributes that, this now goes down to 95 in taxable income. 9,500 in taxable income. Now he made the Roth IRA contribution now. So this Roth IRA he can use to invest in other properties. He keeps building this up. You can use a Roth IRA for other different investment tools if you want. But I just want to be really simple today. So his taxable income now from $35K to $9,500, right? Just by applying, a couple strategies on what he needs and where does he want to go within real estate. So I hope this has been helpful. Hope I haven't been too confusing for you guys, but this has kind of been a basic example of why people need tax planning. So if you guys are not in real estate, you're a small business organization, we like to help small business organizations out too, because they're getting hit with this, where is it, that 15.3%, they're getting double tax, 15.3%, then their income tax, then their state tax, right? So if you guys running a small business organization, you need tax planning as well. So again, it is November the 1st. We have 2 months left out of 2020. And I know it's been rough. I know it's been a wild year. But reach out to us at dudleyaccountingservices.com and we'll get to you. The first 10 to 15 minutes are free, just to gain an understanding of where you're at and see if, we can even work with each other, see if we're aligned, see if we get along, right? You don't want to work with somebody you don't really like. So the first 10 to 15 minutes are free. So go ahead and book your appointment. Visit my website, find out what's going on with me, what I'm about. It's pretty simple. So I'm on YouTube, Facebook, Instagram, and TikTok. I'm not cool yet, but it's coming along. I'm getting there. So if this has been helpful, go ahead and like this video. Give it a thumbs up, and go ahead and hit that subscribe button. Got more from the American Dream in real estate. Come to you soon. I'll see you next Sunday, family. Peace.